are the three questions you need to know how to answer before you apply for Social Security? Plus, we all hear about the benefit of a Roth conversion, but there are certainly some pitfalls that lurk out there that you need to be aware of. Welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on Sunday mornings at 9 a.m. on the News Radio WFLA Orlando network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web, with over 12,000 downloads of our podcasts over the series of podcasts that we have generated over the years. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So before we get to Social Security and the pitfalls of Roth conversions, we want to take a moment and talk a little bit about debt. And that's not necessarily a fun topic, but it's certainly a topic that weighs on many people these days, particularly during the current environment of COVID, affecting so many people and so many jobs that have been lost and so many businesses that have been forced to shut down, that it's important to really start to talk about the conversation of debt and what you can do to try and improve that. So we'll go sort of through a series of sort of Q&As, if you will, about debt on the program this morning. And the first Q&A, I guess, or the first question would be, how do people get into debt in the first place? And generally, when we think of debt, it usually involves really one of two different categories. There's the notion that people often get confused of, which is the difference between wants versus needs. I think far too often we think of something that we want as a need when it's really not. And certainly what we saw in the early days of the pandemic back in April and May is that people really kind of were forced into this notion of, okay, I've got my needs, paying for my rent or my mortgage, buying food, paying the power bill, but then all of the other stuff out there, like going to restaurants or bars or movies or what have you, that can sort of be in the want category. And if you get those two confused, you can see very quickly where your debt can get out of control if you're spending too much on the want side, whether that's keeping up with the Joneses or just trying to be and have the latest. Oftentimes that's how the death spiral, so to speak, can start to happen for many people. And then the other set of circumstances, I think, where debt can easily get created and create a problem are circumstances that can sometimes occur largely beyond people's control. So that would be the notion of an emergency or a loss of job or a relationship. Maybe that's with the spouse, maybe that's with the kids, that generates a need for money. And then, of course, losing one's job. So that helps to set the stage for how people can get into debt in sort of those two main categories. And we urge you to kind of think about, if you're falling into one of those categories, which category it is, and is it something that you can start to control? Because the difference between wants and needs is the best way, once you have an understanding of that, that's the best way to try and get debt under control. And here in a little bit, we'll have some tips on how to actually do it, because the reality is once you're in debt, it really creates a host of problems, right? I mean, beyond just affecting your credit score, which then determines the interest rate that you have in terms of being able to borrow, it certainly does also affect your general debt level. Becomes a slippery slope, right? I mean, so if you borrow money, and borrowing money then means that you've got an extra payment. And if you already are feeling a little squeezed with your income versus your expenses, now when you borrow money, you now have an extra payment, which is going to put even more pressure on that cash flow. And very quickly things can spiral out of control, because if you have that payment and then you wind up then having to borrow a little bit more money, then the payment keeps going up, and very quickly you wind up having a lot more payments, and it becomes very difficult to get on top of the debt and ultimately get rid of it. And then lastly, the reality is that having debt is not good for your health or your relationships, right? Having debt keeps you awake at night, creates stress. That stress can lead to medical problems, and more importantly, it can certainly lead to relationship issues, whether that be with kids or spouse. Oftentimes, finances is quoted as the most common reason for divorces. So it's so important to understand debt, kind of the situations that can cause it, and what the impact is on it, because the impact is much, much greater than just, oh, I owe, X amount of dollars to Y lender. The reality is that it can have a much greater impact. In order to really understand that impact, I think it's important to understand the 5 components that make up your credit score. And I know in the past we've certainly done some programs on this and really kind of gotten into detail on how your credit score is made up and the parts. But just to kind of quickly recap that, there's basically 5 different things that go into your credit score that help to determine it. And the biggest of that is your payment history. That amounts for about 35% of your credit score. And payment history is as you would expect, right? Are you paying your bills on time, or are you constantly late? The other factor that goes into your credit score, sort of the second biggest factor, which accounts for about 30%, that is, of course, how much do you owe? Do you owe a whole lot, or do you owe a little? Those 2 factors between are you paying things on time and what you owe account for about 2/3 of your credit score. The remaining third is a mix of 3 different things that involves whether you're applying for new credit, what your credit mix is, and the length of your credit history. So all of those things sort of come together to determine the credit score. And so if you're looking to try and improve on your credit score, there are certainly some documents that you need to get your hands on. And one of those documents is perhaps the hardest one to actually get your hands on, because it's not a document that comes to you in a nice pretty envelope every month. It's actually one that you're going to have to create for yourself. And that document is called a budget, because creating a budget means that you're sitting down and you're keeping track of not just the income that's coming in, but the expenses that are going out. And that's how you can create a budget, because it's through the tracking of that you're going to be able to ultimately really get on top of your debt. Because after all, debt is a problem because you don't have enough income coming in to cover the expenses, or maybe you're spending too much on the expenses. The only way to figure out where the problem is by keeping track and maintaining a budget that tracks the income in the expenses. So in terms of what documents you need to try and get on top of the debt, it starts with that budget, which is hard to do because that means you're going to have to sit down and keep track of your expenses on a regular basis. Beyond that, obviously getting a copy of your credit report is a good way to check where your debt is, who you owe money to, and the like. And then certainly we often encourage people to get a hold of the actual statements on their credit cards or on their loans or on their student loans that they have, because those actual statements are going to show you the real details of exactly how much is owed, what the interest rate is, and all that. So those are the 3 documents you need to get your hands on in order to help improve your debt. Number 1, budget. Number 2, credit report. Number 3, the actual statements. We're going to continue this conversation on debt. Coming up next, we're going to talk about some of the moves you can make now to help get out of debt. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning News Radio, WFLA, Orlando. Debt this morning on the program, how people find themselves in debt, some of the things that they can do and to document to try and get out of debt. In this segment of the program, we're going to talk about some of the moves that you can make to try and reduce your debt, or in fact, ultimately get out of debt, because that should be your goal regardless. So welcome back to the program. This is Dollars and Cents. My name is Joel Garris of Nelson Financial Planning. certified financial planner, certified financial fiduciary with Nelson Financial Planning. Our team of certified financial fiduciaries at Nelson Financial Planning stands ready this week to help you change your life with a successful financial plan, maybe one that includes getting out of debt, that provides you with peace of mind for the future. So this segment of the program, we're going to talk about some of the moves that you should make to try and get out of debt. And we talked a little bit about this last time in the last segment about some of the documents you need to help yourself start the process of getting out of debt. So we'll start this segment off with re-emphasizing one of the things that we talked about in the last segment, which is that the single best way to get yourself out of debt is start tracking where your money is going. Not just the income coming in, but the expenses going out. There's a ton of technology on that, folks, these days that can help make that easier, whether that's some apps, whether that's your phone, a lot of things out there that really help to make that process a little bit easier. So if you're really serious about getting out of debt, start with figuring out how to track the money that you're spending on a regular basis. And then next, you certainly have to take advantage of the low interest rates, right? I mean, it's no secret, interest rates are at historical lows. To put it into perspective, if you owe $100,000, like a $100,000 mortgage, 30-year repayment, and the interest rate is 6%, you're going to pay roughly $600 a month on that $100,000 loan at 6% with a 30-year payback schedule. If the interest rate drops to 3%, which is pretty close to where interest rates are today, then on that same $100,000 over the course of 30 years, the monthly payment would be about $420 a month. That's a 30% difference on the amount of money that you would be required to pay. So certainly want to take advantage of low interest rates, particularly in today's climate. Why? Well, that leads us to the next thing that you can do to help yourself get out of debt, which is that would allow you to make more than the minimum payment. If you make more than the minimum payment, that will help to accelerate the payoff of debt. So if you're taking advantage of the low interest rates, putting less payment towards the payment that you must make, and you put extra money, then that extra money winds up going to reduce down the amount of the debt that you owe in the first place. So certainly want to pay more than the minimum. And then in terms of where you go and how you start, we would say you pay off the highest interest rate first. Pay off the more expensive one first to really try and ultimately avoid getting the cost of having that debt be the highest it can be. By tackling the highest interest rate first, then you're able to really make some progress on eliminating or reducing down the cost that the debt occurs over the course of every single month that you have the debt outstanding. And then lastly, another good suggestion that typically folks make in terms of moves that you can do to try and get out of debt, and this goes to really trying to reduce your expenses, is this notion of don't buy new, buy used, whether that's cars or clothes or what have you. If you're buying used, then you are ultimately not spending as much money on the same item as if you were buying new. So some important things to be thinking about there if you want to try and get out of debt. If you're trying to rebuild credit, maybe you've had some issues in the past, you're trying to get out of debt. At the same point in time, you're trying to also rebuild your credit. Understand, anytime you're trying to rebuild your credit, it's really a marathon and it's not a sprint, because if you come back to the largest item that affects your credit score, it is your payment history. Well, your payment history isn't created based upon 1 month of really being diligent and paying things off on a timely basis. It's a pattern. So when they come up with your credit score, when the credit bureaus determine your credit score, there's a reason why payment history is the largest component that makes up your credit score, and that is because they're looking for patterns. They're looking for patterns over time. So 1 month of paying things on time is not really going to make that big of an impact on your credit score. You need to be doing that on a regular basis. And then next, certainly paying off those high rates, first reducing down the total amount of debt that you own. The other item that we suggest to try and rebuild credit is don't necessarily close out those unused cards first. Remember, one of the factors that goes into your credit score is the length of your credit history. So if you close out a credit card that you've had for 10 years, the reality is that that's going to reduce down the length of your credit history, because that credit card you had for 10 years was really helping to give your credit history a longer average time period. Next up, if you're trying to improve your credit and rebuild it, you certainly want to avoid taking on new credit, right? Even if the store that you're walking into, although these days with COVID, probably not walking into too many stores, the reality is that even the store that says, if you could get 20% off if you apply for our credit card now, be careful on that and really stay clear of that, because that just means that you went for new credit. That means you got another credit card, and if you don't pay that off on time, those store credit cards have some of the highest interest rates out there of any credit card available. So be careful about that. And then lastly, like we said, get a copy of the credit report and take a look at it. If there are inaccuracies on it, then you certainly want to try and work to eliminate those inaccuracies. Maybe even cut a deal with the lender who reported it, with the notion of, if I pay you now, will you reach back out to the credit bureaus and take that off of my credit report? So those are some of the things that you can do to try and rebuild your credit. In terms of kind of this overall situation of debt and the thoughts on that, again, you've really got, if you want to get yourself out of debt, if you want to improve your debt, improve your credit score, it's really about tracking how you're spending money. Money coming in, money going out, that's big. And the reason that trying to get out of debt is as important as it is there's other things that you have to do. If nothing else, COVID taught us the importance of having an emergency savings fund, because it's emergencies like this that you're going to want extra money for. And then once that's taken care of, the reality is too that you've also got a plan for retirement and educating your kids and buying a house, and the list goes on for things that you need money for. And that's why it's important. Got to get the debt under control so that you can continue on to try and do these other things in life that are more important and certainly more fun, right? More fun to like own a house or to help educate your kid than pay a credit card company, I would submit. So certainly a full conversation about debt and some of the things that go with that, and hopefully given you all some tips on how best to address it and most importantly get out of it. Now, I want to shift some gears here in the last couple minutes of this segment, and I want to alert our listeners to an ongoing scam that is happening. A few weeks ago, we did an entire large part of the program was on scams, particularly the IRS Dirty Dozen of scams that are the most popular. And as you might well imagine, during tough times like a pandemic, there's an increase in the amount of scams that are out there. And so this comes to us through an email from our good friends Rick and Leanne, and it says, I thought we would let you know that the scam calls supposedly from the IRS are rampant again. They must be getting desperate, as they sometimes leave a callback number to call and talk to an officer. We hope no one has fallen for any of them. I've personally had a dozen calls in the past 10 days. I have had 4 today alone. This is an email from last Friday. This is getting ridiculous. It is good to remind your listeners on your show Sunday morning to be watchful. There's your reminder. Be watchful. The IRS is not going to call you and demand money and tell you that you're going to go to jail if you don't pay them. It's a scam. Do not do it. It is peak season for that, and they are out there, and they're out there to separate you from your money illegally. So do not do it. Hang up the phone. Apparently, based upon what Rick's telling us in this email, it can be rampant for people these days. So beware of that. When we get back, we'll continue the conversation here. We're going to talk about Roths conversions and some of the pitfalls that might happen on a Roth conversion. Coming up next here on Dollars and Cents with Joel Garris on News Radio WFLA Orlando. These days are recommending Roth IRA conversions, particularly with the notion that tax rates are at historical lows. And from that perspective, certainly that Roth IRA conversion makes sense, but there's a number of pitfalls that folks need to be aware of before they decide to do that conversion. Welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you every Sunday morning on the News Radio Orlando network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web, with over 12,000 downloads of our episodes. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So, what's the basics of a Roth conversion in the first place? You hear a lot of folks talking about that, and really the process there is that you take part or maybe all of your individual retirement account, your IRA, and you convert it to a Roth. And so what that process means is that in your IRA, the money that's traditionally in an IRA is money that you put in on a pre-tax basis. So that money is money that has not had any taxes paid on it, and so it is tax deferred until such time as you draw it out in retirement, whereupon you've got to pay taxes on it every dollar you take out. That's your traditional IRA. On a Roth, on the other hand, it's sort of the flip of that, whereby the Roth represents contributions you made on an after-tax basis, meaning you didn't take a tax deduction for it when you made the contribution, and when you retire, you get to take the money out of the Roth and not have to worry about any taxes whatsoever. So when you do a conversion, what you do is you basically convert the IRA money over to after-tax money by basically paying all of the taxes on the amount that you convert. So let's say you convert $100,000 of an IRA to a Roth. That means that you're going to take that $100,000 and put that into your tax return for the year in which you did the conversion, and then you've got to pay the taxes on that at one shot. And that's how the conversion works. Ultimately, the $100,000 winds up in a Roth, but understand that you've still got to deal with the tax bill that comes from taking $100,000 out of the IRA and sliding it over to the Roth. So that's the conversion process itself. Certainly makes some sense when tax rates are low and the expectation is that tax rates are going to be high, but there's definitely some pitfalls to be aware of before you just jump straight into it. And there's a number of pitfalls, and that's why we encourage people to really look at the numbers on the conversion before you do it, not after, because there's a number of things that can happen that could surprise you and create a much greater tax liability than you realize. So we're going to hit some of the highlights on that and make sure that you're thinking about that if in fact you're considering a conversion, a Roth conversion. And first and foremost of all is that if you're currently on Medicare and you do a conversion, remember the amount that you convert comes into your tax return as part of your income. So that means that your total income picture is going to increase by the amount that you converted. And if it increases above a certain level, and for Medicare purposes, that's above $87,000 if you're single, above $174,000 if you're a married couple, what happens there is that your Medicare premiums will go up if you're above those income thresholds. Most people don't realize this until it happens to them, but the amount that you actually pay for Medicare, Part B, Part D, is a function of how much income you make. You make more income above those thresholds that we just shared with you, then you're going to pay more. How much more? Well, your premium for Part B could be an extra $58 roughly per month. Your premium for Part D could be roughly an extra $12 per month. So put those two together and it's about an extra $70 a month that it could happen that your Medicare premiums have gone up. And that's just the start. The higher your income level, the more those Medicare premiums jump to the point where the maximum level, highest level of income, highest increase in the Medicare premiums could be as much as $350 per month on Part B and as much as $76 per month on Part D. So know that if you're going to do a conversion, that you've got to kind of see all of the ripples, and that's just one ripple that can happen. Another one is that you may very well have to pay the Medicare taxes that come with higher income levels. So if your income as a single person is above 200,000, and again, got to include the amount that you converted over now as part of that total income, or if you're married above 250,000, there is a net investment income tax, basically an extra Medicare tax, that works out to be 3.8%, almost 4%, that you would then have to pay on top of that. So definitely some things that can ripple through, just as they can if you are getting Obamacare. So let's say you're not collecting Medicare, your income is not going to break above these thresholds that would trigger these extra Medicare taxes. But if you're getting Obamacare and you're getting that premium tax credit where your income is now lower, less than about 65,000 of income, and you're eligible for those advanced tax credits that come with that health insurance that you would get through Obamacare. If you do a conversion, that's extra income that would then push you over those limits, and you might very well find that you have to return all of that premium tax credit you got. And if you've ever seen anybody return that has had to do that, it can be a crazy big number, like $12,000 type of number. So just know that when you do a conversion, comes into income. If you're getting a premium tax credit based upon low income, doing a conversion is going to make you into high income, and that's going to create a problem on your taxes. Just so as with Social Security as well, Social Security income, different lines will adjust to make you pay either 50% of your Social Security or include 50% of your Social Security as income on your tax return, all the way up to 85%. And those aren't very high thresholds on that. So for Social Security, if you're single, above 34,000, married above 44,000, you could wind up having 85% of your Social Security included in your income. And again, doing a conversion, extra income could easily make you above those thresholds. Similarly, capital gains rates. Capital gains rates are at 0% if you're in the 15% tax bracket, but if you're in the higher brackets, then that 0% goes to 15% pretty quickly. And where does that happen? If you're single, making about 60,000 gross income, married couples making about 100,000 gross income. So again, not big thresholds of income that can trigger a big ripple effect in terms of the other tax rates that may be applicable to you. So another place where you can kind of run into some surprises is that, remember, your medical expenses, to the extent you're writing off your medical expenses, your dental expenses, the amount that you can write off is subject to a threshold that's based upon your adjusted gross income. So typically the threshold is 7.5% of adjusted gross income. But again, if you did a conversion, you've got extra income, that threshold then goes up much more because it's 7.5% of a bigger number, which means that you may very well find your medical, dental expenses winds up getting more limited in terms of your ability to write off. And then, heaven forbid, that you don't live in Florida. Of course, why wouldn't you live in Florida, right? We're like sunny all the time. There's no state income taxes. The reality is that that's where another part of this can potentially bite you. If you live in a state that's got state income tax, you do a conversion, remember, it's not just federal taxes you're going to owe on that. You're going to owe state income taxes as well. Bottom line, generally speaking, it's a great time to look at the option of a Roth IRA conversion. I'm not saying that at all, okay? Because tax rates are clearly very, very low in today's environment. But you've got to run the numbers and you've got to see whether you're going to be impacted by the ripple effect that extra income can have on your tax return. So many different things on one's tax return are correlated to the amount of income that they have. And when those income thresholds get triggered, you're going to wind up paying a whole lot more than you may expect than just looking purely at, oh, I'm converting X number of dollars on a Roth conversion. So certainly something to think about on that. We'll take a break. When we get back, we'll continue the conversation here on Dollars and Cents with 3 questions that you need to answer before applying for Social Security. All that and more coming up next on the program. 3 questions that you need to answer before applying for Social Security. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're coming to you here on News Radio Orlando, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So be sure to check us out on all those social media channels. My name is Joel Garris of Nelson Financial Planning. I'm a certified financial fiduciary, certified financial planner. Our team of certified financial fiduciaries at Nelson Financial Planning stands ready this very week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So, Social Security, obviously a very important part of really everybody's retirement. And in order to get the most out of it, you need to know the answers to certain questions, that's for sure. Social Security is typically intended to cover about 1/3 of your retirement income. So hopefully you're doing something more than just Social Security. The reality is that there are 3 questions that you need to be asking yourself before you apply for Social Security that are going to impact how much Social Security you get. And the first one, hopefully, is one that everybody knows, but it often bears repeating, is that your age affects your benefit, right? So Social Security has a couple of ages that you need to be aware of. You can start to get Social Security as early as age 62, or you can delay it all the way up to age 70. Well, that's 8 years. That's a pretty big gap, pretty good sized length of time. And so there's some decisions that you need to make depending upon how old you are, and certainly what the rest of your investment and retirement income picture looks like. But generally, the earlier you start, right, the less you're going to get, and that reduction is, of course, permanent. So that means you've got to know your FRA. What's the FRA? That is your full retirement age under Social Security, and it is in fact changing for many people right now as they near retirement. So if you were born prior to 1954, your full retirement age is 66. If you were born between 1955 and 1960, there's a gradual increase in that every couple of months for every year, from 66 all the way to age 67. So in 1960, if you were born after 1960, your full retirement age is 67. Why does that matter? Because if you start to collect at age 62, then your benefit at age 62 is only going to be about 70% if your full retirement age is 67, or 75% of what you would have gotten at full retirement age if in fact your full retirement age is 66. Why? Because they look at the number of months before you get to your full retirement age if you are collecting early. So it's a calculation based precisely upon the number of months that you are applying early relative to your full retirement age. Similarly, on the opposite end, if you're waiting until age 70, then you wind up getting 124% of the benefit that you would have gotten if your full retirement age is at 67. On the other hand, it's 132% of that benefit that you would have gotten if your full retirement age is 66. So that's why it's important to understand how your age affects Social Security. Not just if I apply early, my benefit gets reduced, but also what is my full retirement age, and because that obviously is changing depending upon what year you were born in, because it's in the middle of sort of transitioning from age 66 to age 67. So it's important. The decision to apply for Social Security early is a very detailed decision, and one that really also takes into account other assets, other incomes, other sources of retirement. If you don't have that much saved for retirement, then you may need to delay for the higher amount. If in fact you're retiring early, maybe you do take the amount of Social Security early. Everybody's unique on that. Certainly a number of considerations to consider, but just bottom line is, before you apply, you better know your age and how it impacts your Social Security. Next is if you're going to lose any benefits back to the government, right? You certainly want to know that, because if you're going to apply for Social Security and then turn around and have to give it back, you may want to change your mind or make a different decision on that. And so you're going to wind up losing your Social Security benefits back to the government in one of two potential ways. Number one, taxes, because remember, it's taxable above a certain threshold. And then number two, if you are still working. So taxes, you can have to pay up to 85% of your Social Security has to be included in your income. And then if it's included in your income, then that means you've got to pay taxes on it. That's a range that starts at not included in your income, up to 50%, and all the way up to 85% of that Social Security that needs to be included in your income. And then thereupon, you're going to pay taxes on it. So definitely got to watch out for taxes, because that's always there. And then if you're under your full retirement age, remember that's either 66 or 67, or if you're in that age group approaching born in 1960, it may be sort of creeping up from 66 to 67. If you are under your full retirement age, then how much money you make makes a difference as to how much you're going to keep. If you're earning work income, now this doesn't apply to pension income, rent income, or investment income, or anything like that. Work income, if your work income is over $18,240 for the year 2020, then for every $2 over, you're going to have to return back $1 of that Social Security. The exception in the year in which you turn age, your full retirement age, is if your income, earned income, is over $48,600 for the year 2020. Then for every $3 you're over that, then you have to return $1. Bottom line, if you're working and under your full retirement age and looking at trying to determine whether to collect Social Security, you certainly want to look at those thresholds and whether you're going to have to wind up paying it back because of the earnings that you're still making. And then lastly, it's important to know that the decision that you make with Social Security is going to affect other family members. You may not be the only one that needs to look at how much you're getting from Social Security, because you may not be the only one claiming on your work record, right? Your spouse has the ability to claim on it, and if you start before the full retirement age, then that's a permanent reduction to them in terms of how much they can apply to get off of your record. Similarly, when you die, their benefit would step up to yours, assuming yours is the higher amount. If you started early, then that's going to be less of an amount. So understand that it's not just you that is going to be affected by the amount of your Social Security, but others as well, particularly your spouse. And to the extent that you have minor children, then they also their benefits also would be affected. So those are certainly sort of the three big questions to ask in terms of, before you apply for Social Security, making sure that you have an understanding of what's your age, how it impacts it, what's your full retirement age, and the range of ages that you can pick from in terms of collecting your Social Security, and then whether you're going to lose any of the benefits back to the government, because if you're going to lose a bunch back to the government, maybe you want to continue to delay. And then, of course, your decision, know that your decision that you make with Social Security certainly does affect others, particularly your spouse. So some things to consider when it comes to Social Security. We are going to wrap it on up and get it on out of here. Thank you for listening to this week's program. We'll be back next week, same time, same channel. This is Dollars and Cents with Joel Garris of Nelson Financial Planning.